Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures fluctuating this morning after a volatile week for investors. The S&P on pace to end the week higher after the president reversed course on his reciprocal tariffs while simultaneously boosting tariffs on China. But equities still down since the initial announcement on April 2nd. Meantime, the U.S. dollar taking a hit as the U.S.-China trade war heats up while gold rose to a record. Bank of America strategists warning clients to sell the rip and risk on rallies until trade war risks fade.
Plus, bank earnings kicking off this morning. Wall Street's biggest banks benefiting from the trade-induced policies of President Trump, with JPMorgan notching record revenue and trading as Morgan Stanley traders beat expectations for revenue. Meanwhile, JPMorgan CEO Jamie Dimon urged a quick resolution to the uncertainties sparked by the tariffs, warning that some of the negative effects would worsen over time and would be hard to undo.
And the latest on the trade war, China will raise tariffs on all U.S. goods from 84% to 125% starting tomorrow, calling the Trump administration's actions a joke and saying it no longer considers them worth matching. Trump and Xi Jinping are locked in a standoff over who will move to de-escalate first. Trump has said he's waiting for a call from Beijing, while Chinese officials have repeatedly said they're open to negotiations but won't be bullied into talking.
Tariffs are still out there. They're still on at the 10% level. They're on at the Chinese level, and they're on sectors. We still have tariffs higher than we have in the last 100 years, even after this quote unquote pause.
No one's going to pay that for Chinese imported goods. It's like, well, that is a distinct possibility.
We are making a choice to have the unemployment rate go up, the inflation rate go up. All of this is going to put the Fed in the box.
Basically, the tariff rates have gotten so high that we're going to just have to either reallocate from China or they're likely to just come down at some point. So our imports from China are likely to fall very close to zero if these tariffs remain above 100%.
There is going to be an economic slowing. You can't just sort of pull these levers willy-nilly and expect nothing bad to happen in the economy.
T-shirts could be the new eggs here shortly.
The trade war heating up overnight as China retaliates against the U.S. with a 125% tariff on all U.S. goods. Stock futures actually moving to the upside this morning as the trade war continues to heat up. Volatile moves throughout the morning trade here, but Bank of America strategists saying sell the rip and risk on rallies until things cool off. Joining us now with more, Yahoo Finance markets reporter Josh Schaefer. Josh, this exact moment in the market withstanding, it seems like the tumult is nowhere near the end, even with this 90-day pause.
You guys just played a mashup of, I think, 5 or 6 guests, and basically none of them had anything positive to say about where the tariff story has gone in the last week, right? So I think that's just the reality of where we're at here, right? So if you look at something just simply like the effective U.S. tariff rate, right? That was at Yale Budget Lab has been doing great estimations on this. Ernie Tedeschi over there has been following it minute by minute. They were at 22.5%, still your highest level in basically a century. And that was after Liberation Day on April 2nd. You come to now, the effective U.S. tariff rate has only gone up in the last week. We took tariffs from other countries and essentially just put them on China. The amount that the U.S. is actually tariffing countries has only gone up. It's now at 27%. So I think the reality is that story just isn't going anywhere, right? And I was speaking to BNP chief economist James Egelhoff yesterday, and he was sort of saying, well, the 90-day pause is also an issue too, right? When you think about the fact that if the uncertainty has been sort of the central problem here, what does a 90-day pause do for businesses?
Yeah.
Probably nothing, right? Now you've just extended the uncertainty window. Now you have 90 more days where you're wondering, do I need to move where I'm sourcing goods from? How do I operate my business? And so you're just extending that period longer. And I think that's why you end up with calls like you saw from B of A's Michael Hartnett today, which basically said, until the trade war settles down, I don't feel good about stocks here.
Sell a rally.
Yeah, and I think that's basically what you're seeing in the market too.
I mean, we can't stress that enough. Like, we've gone from people saying, hey, buy the dips, to, hey, no, sell the rally. Like, just how quickly of a pivot that's also been made, essentially, because when we started off this year, it was, all right, these valuations, they need to come down a little bit, look for more ripe opportunities to come in. When valuations do compress a little bit more, you got that. But then we had the initiation of the trade standoff, and then valuations, it didn't become the main story. It became, okay, now there's so much uncertainty. The valuation reset almost doesn't even matter. It just more so matters that you're well diversified in whatever is going to play out in this next range.
Right, Brad. And I think the other thing that we came into this year with too is we felt like the economy was, or consensus felt like the U.S. economy was probably going to grow above 2% again, right? Now you're moving to consensus probably coming closer to, it's definitely below 2%. You're seeing a lot of economists talk about below 1%. Some economists are talking about recession. That's a call that JPMorgan has made. That's a call that Neil Dutta at Renmac has made. And so I think you start to just piece these things together, and the overall story just is not that good right now. And the question is still, how much worse will it get? Right. Not necessarily how much better is it going to get. And so that puts you in a position where you just don't feel that comfortable getting into the market there. And the other thing I would add with that is just economic data had already sort of been slowing in some ways. And I think you're now at a moment where people are just waiting to see more on the growth front. You've had 2 good inflation prints. You had a good producer price index report this morning. You had a good consumer price index report yesterday. Normally stocks rally off that news. S&P 500 futures are up about 0.3%, I think we just showed. So that's just not happening this morning, and it didn't happen yesterday. I think the S&P 500 fell, what did we close? Off 4% on a better than expected CPI print? Yeah. That's not normal. That's not what this market has been for the past 2 years, and I think it gives you a good sense of where the market's at, and sometimes when the market's trading like that, you need to just listen to it.
Josh, thank you so much. Really appreciate it. A volatile week for Wall Street, with some market participants calling for emergency action from the Fed before the president backed off on his trade plans, but Fed officials throwing cold water on immediate intervention. Jennifer Schomburger standing by now with a special guest. Hey, Jennifer.
Thanks so much, Maddie. For more insight on this volatile environment, I want to welcome into the program Boston Fed President Susan Collins. Susan, it's great to see you. Thank you so much for sitting down with me.
Absolutely. I'm delighted to be here this morning.
It's great to have you in Washington, too.
Yeah, I'd love to come visit Washington. Absolutely.
The president has paused steep reciprocal tariffs for 90 days, but he has retained the universal 10% tariff. At the same time, he ratcheted up tariffs on China to 145%. This morning, China is hitting back. What concerns you most about this current environment as tariffs stand right now, and as well as the impact on the economy?
Yeah, well, the higher the increase in tariffs and the more broad-based, of course, the larger the impact would be on our economy, on inflation, on growth. But as I think about things, my starting point really is that we came into the first quarter of this year with economic conditions that were quite solid overall, in terms of labor markets, in terms of inflation that was slowly, perhaps unevenly, moving back down. And so in that context, the tariff increases that have been announced and the uncertainty in terms of tariff, but also other policies, certainly does influence the outlook and also clouds it. And I think it's important to recognize that up front. So, my outlook would be for higher tariffs higher inflation, throughout this year with slower growth. And, the uncertainty, again, does cloud the outlook, and there are a number of other things to watch, from the financial market volatility, while markets continue to function well, to possible impacts on inflation expectations, which could also be a concern. So those are some of the things that I'm quite focused on as I look forward for the U.S. economy.
Do you believe we are in a full-blown trade war with China right now? And what are the implications there, given how high tariffs are on the U.S. and now from China's side as well? Do you see the U.S. economy decoupling from China? And what are the implications in terms of supply chains, product availability, and pricing in this country?
Yeah, so there are a lot of pieces to that. Certainly the tariffs that have been announced on our imports from China, and the announcements that China made are extremely significant, and that is concerning in terms of potential impacts. The integration of U.S. supply chains and production processes has evolved over many, many years, and China has been a really integral part of that. And so, looking forward, the implications in terms of costs and efficiencies are, significant. And when I talk to firms in the First District, they're obviously very focused on that. Many firms, particularly in apparel, in some types of electronics, had shifted some processes away from China, for example, to other countries in Asia relative to where they were 6 to 8 years ago. At the same time, significant investments like that are difficult to make in periods of extreme uncertainty, especially if, as a firm, you have recently made major adjustments. So there are a variety of things to recognize looking forward, and what I hear is really a pervasive wait-and-see approach as firms consider how to react to an environment that is highly uncertain and with the tariffs quite elevated. 10% overall is very high. That is a large increase. And then, of course, the ones on China are much more substantial.
You mentioned that you expect slower growth this year. The Fed has penciled in 1.7% for GDP. But given the tit for tat that we're seeing now, specifically with China, are the odds growing for a recession? Are you growing more concerned that we could see a contraction in growth later this year?
Well, as I mentioned at the outset, the higher the tariffs are, the more the potential slowdown in growth, as well as elevation in inflation that one would expect. Certainly there are more adverse scenarios that I wouldn't rule out, but my own kind of modal scenario is one of slower growth, not a significant downturn, but there are a number of factors to watch in that context more broadly. In particular, the kind of wait and see approach that I mentioned. I think the financial market movements are something to stay focused on as well. And so my current outlook, again, is not the more adverse one, but I wouldn't rule it out.
In terms of the outlook for inflation, we stand at 2.8% right now on inflation. And you mentioned in your speech last night that if we had an effective tariff rate of just over 10%, then we could see inflation well above 3% this year. However, given that the tariff on China is 145%, JPMorgan's estimating that the effective rate could be as high as north of 25%, so more than double. So could we be looking at inflation of over 5% this year, or as high as what we saw during the pandemic?
Well, so there are a number of factors of that. I mean, as I mentioned, the higher they are, the bigger the impact would be, certainly. Boston Fed staff is assessing and estimating what the ranges would be. And in that context, it's really important to take into account the fact that tariffs are applied not just to final goods that are imported in, but also to imported intermediates, which are about 44% or so of those imports. Are much more broad-based than many people realize. And so the breadth of sectors that would be impacted is quite large. And so the estimates that I mentioned when I was at Georgetown yesterday do take all of those factors into account. How long they would take to impact inflation is hard to tell because there are a number of factors, right? Even if the tariff amount, the level of tariffs don't keep moving, how long it takes for firms to adjust to pass through. What I hear when I talk to firms, what we've heard in surveys that we do, is that that's likely to take a year or more, perhaps as long as 2 years. And so the persistence and how much of the increase we would see in 2025 versus perhaps longer than that is a little hard to assess in that standpoint. But I would expect inflation rates well over 3% for 2025 in the current context.
To your point then, you and your colleagues have stressed keeping long-term inflation expectations in check. And some of your colleagues have said that that raises the bar on rate cuts for later this year. Do you share that assessment? Does that put off the notion of rate cuts?
I do think it's a really important consideration. One of the very important assets that the Federal Reserve has is its credibility, and that is manifested in anchored longer-term inflation expectations. One of the key reasons that the disinflation was not associated with larger downturns that we've seen so far, was associated with that anchoring. And so it's something I watch very closely going forward. Many indicators of longer-term inflation expectations are still in the range that we would hope to see, but some of them have been more elevated recently. And so that very much would factor into my own view and how much confidence I would have in inflation moving down over the longer term. That's what I would need to be looking at to consider additional normalization of policy rates.
So then do you see a scenario where you end up holding rates steady for the entire year?
So I think at this point, my expectation is that we are likely to have to hold for longer than I had before. It may still be appropriate to begin normalizing towards the end of the year, but I would need to see that confidence, and anchored inflation expectations at the longer term would be a key part of that determination on my part.
Susan, we'll have to leave the live portion of our interview here, but thank you so much as always for your insights. Great to have you.
It's a pleasure to talk with you.
That's Susan Collins, president of the Boston Fed. We will continue this conversation on tape. Guys, I'll send it back to you in New York for now.
All right, thanks so much, Jennifer. Appreciate it. Great conversation. Wall Street executives struck a cautious tone when talking about the path forward for the U.S. economy in first quarter earnings. JPMorgan's Jamie Dimon cautioned of considerable turbulence in the near term, while Wells Fargo's Charlie Schiff said timely resolution would be best for markets here. Now, all three banks, they beat on profit in the first quarter, and right now we're seeing them move lower pre-market. With us to discuss, we've got Chris Whalen, Whalen Global Advisors chairman. Chris, great to have you here with us. On the outset of these earnings, what grade would you be giving these banks as they're starting to kind of kick off earnings season and set the tone for how CEOs are talking about the economy?
Well, you said cautious. I think that's the word. The first quarter is normally the strongest quarter for the industry. And what you're seeing is slight increases in reserves. JPMorgan hit that number with some sales of assets and also expense reductions. So I think overall it's an okay quarter. Morgan Stanley, interestingly, saw client assets fall single digits. It'll be very interesting to see what the second quarter looks like. Because if you think about the first quarter, really January, February were okay. We did have some sell-off in financials, really going back to last November. But then March, the change and the uncertainty accelerated, and you saw Jamie Dimon essentially pre-announce on commercial exposures for the rest of the year, which is unusual to say the least.
Yeah, and it's interesting, too, in the context of Wells Fargo, they did not lower their net interest income guidance. I wonder if you buy that and how you're thinking about guidance from these banks amid the macro.
I have written very positively about Wells, but this is not the same Wells Fargo as 3 years ago. They have exited a lot of different areas of the bank, commercial real estate, residential real estate. They are shrinking their book. So when you look at them, it was not bad. There wasn't much going on one way or another. There's still around 70% operating efficiency, which is 15 points above JPMorgan. So they need to do some work there. Jamie Dimon has such a huge advantage in terms of operating efficiency. He's down in the low 50s. So there's only small banks that can really chase him at those levels. Citi, the rest of them are 10, 15 points above him. And what that means is that less money drops down at the bottom line.
Chris, financials were one of the sectors that were bullish calls for many investment firms coming into the start of the year. Positive deal making, they were looking at the markets and investment banking revenue as well. In the absence of some of those major catalysts for the banks, what is your outlook? How are you assessing the investability of them right now?
Well, after last year, when we saw financials galloping along at 40, 50% annual rates of increase, you had to know that they were going to sell off. The third quarter was a very strong quarter for the industry, big volumes in lending, because people thought we were going to have a rate cut, but we didn't. So now what you see is that the entire sector is basically given back all of the gains from 2024. Where do we go now? I think we're going to see higher credit expenses, hopefully some deposit growth since the Fed is slowing down the shrinkage of the balance sheet. But as Jamie Dimon said, appropriately in the fourth quarter, we don't see a lot of demand for our products. You see the same problem at Goldman. Goldman is still going into new areas simply because they're looking for growth. And I think overall, 2025 is going to be about credit, first and foremost on the commercial side. But by the end of the year, we're also going to see it on the consumer side as well.
Let's talk about that because JPMorgan also talked about debit and credit card sales volume being up 7% year over year. Is credit safe for now?
They're being very careful with credit. All of the banks are. They haven't pulled back in terms of the amount of unused credit they have out there yet, but I think you're going to see that. Jamie Dimon grows whether he wants to or not. You got to realize that bank is so attractive for many people in times like this when there's market volatility that they just pile in there deposits at JPMorgan. So, in a sense, he would love to be smaller. He would have higher equity returns if he was smaller, but they don't have that choice. Same thing with all of the top four. They will grow in times of uncertainty because people are hiding there. That's what it comes down to. But look at what's moving. Gold. Gold is on its way up and Bitcoin's on its way down. I think that's fascinating given that we have Donald Trump in the White House.
It certainly is fascinating. Now you're seeing JPMorgan selling off a bit after ripping to the upside off of those earnings. Chris, thank you. Appreciate it.
Have a great day, guys.
You too. Coming up, all your markets action ahead. Now stock futures in the red. Stick around. Any hope of a trade deal between the U.S. and China dimming even further this morning. China hitting the U.S. back with a 125% tariff. Beijing's trade officials saying a further increase in U.S. tariffs would be meaningless and they plan to ignore them. Chinese President Xi Jinping saying his nation is, quote, not afraid in his first public comments on the escalating trade war. All of this comes after President Trump announced an increased tariff on China totaling 145%. And then you have the 90-day pause for negotiations on all other countries reciprocal tariffs were applied to. So it's hard to imagine China calling Trump to make a deal. Meantime, the Spanish Prime Minister meeting with Xi Jinping, calling on the EU to deepen its ties with China, and Treasury Secretary Scott Bessent saying that would be like cutting your own throat for the EU. Mexico's economy minister looking to raise auto tariff exemptions, and all of this highlighting how hard it's going to be on an individual negotiation basis, all to get it done in the next 90 days, the length of an entire quarter. Brad?
All right, thanks. Growth fears gripping the markets as trade war escalates. Stocks continuing the whipsaw action that we've seen this week after China announces 125% retaliatory tariffs on U.S. goods. Joining us now, we've got Robert Socken, Citi Senior Global Economist. Robert, good to have you here with us. Just the likelihood of a recession in your view.
Thanks so much for having me during these wild swinging times. I'm putting the probability of a U.S. recession at about 40%. I think despite the pause that we got on the reciprocal tariffs, we still have much higher tariffs on those countries than we had a few months ago. The escalating trade war with China is very worrying and can lead to severe disruptions. And so I think we're in a similar spot with recession risk than we were earlier in the week. And it's really due to these tariffs and policy uncertainty, which are going to shave a significant amount of growth off the U.S. economy this year.
And talk to me about how much that growth being shaved off of the economy puts us at risk of a recession, especially if this tit for tat continues with China.
Yeah, absolutely. And one of the key points is whether you are calling for a recession now, in part depends on how strong you thought the economy was at the start of this year before the stresses began. Consensus and myself were around 2.3% growth for the year, give or take. And by our math, the tariffs that have been put in place are going to shave between 1 and 2 percentage points off of U.S. growth. I would be closer to the upper end of that range, which would mean relative to where we were before, we're looking at growth probably at 1% or below. And it's easy to get to bigger numbers from that if you take on secondary effects, like assuming that businesses and consumers are going to pull back because of all of the uncertainty that has been in play in recent weeks. So it's a very concerning situation. And especially with the trade war between the U.S. and China, I think you run the risk of unknown unknowns coming into play. How rapid is trade going to drop off between the two economies? What is that going to do to supply chains? Are we going to see pressures and strains like we saw during the pandemic? So there's all sorts of unknown variables that are in play. And I think in particular, the U.S.-China situation has me worried that we're going to start to see things that we saw during the pandemic in supply chains.
From CEOs that we're speaking with, Robert, it sounds like they're already working through the considerations of just how to have their businesses operate through this novel level of uncertainty. And so even within the economic backdrop, they're thinking about, all right, their own cost and their expense base right now and whether they need to scale that back. How do you think that might flow through and potentially have an adverse impact on the employment situation? I know last week was all the employment rage. That was employment-chella last week, but now we need even more focus renewed on this once again.
Yeah, absolutely. And, this is one of the challenges of measuring the economic impact of the tariffs. There's all sorts of margins of adjustment that can occur. What exporters absorb into their margins, importers absorb into theirs, what gets passed on to consumers. I think companies are going to be looking to cut costs in some way, especially because they're not going to be able to pass on as much to the consumers as maybe they would have been a few years ago. And one way that could happen is through layoffs. And I think that's one of the channels that we're monitoring closely is if these tariffs stay in place and costs do go up a lot, the companies may be looking to economize on staffing. So far, as you mentioned, the labor market was very solid at the beginning of this year. There was even signs it was picking up in some respects. If you look at hiring, layoffs right now are still quite low by historical standards. But this is one of the areas we have to monitor closely because it is an area where companies might have to look to economize.
Robert, final minute. What do you make of the fast take back from big banks about their recession calls this week just because of this 90-day pause? Does that 90-day pause really take a recession risk off the table?
I think there are a couple things that can really push you into a recession call. And I think where the tariffs were before on all of these different countries added up, especially if you assume that you get retaliation from those countries, you could get to a recession call pretty quickly because the retaliation magnifies the negative effects on the U.S. and the rest of the world. But where I'm sitting, even though we got that pause, I think a lot of those channels we were talking about, the uncertainty, the much worsening situation on China are all still in play. And tariffs are much higher than they were on the other countries than they were earlier this year. So to me, maybe it marginally moves you back away from the recession camp, but I haven't changed my probability too much. I was 40% earlier in the week. I'm still there now.
All right, Robert, really appreciate you breaking that down for us. Thank you so much. Brad, we're going to kick it over to you for the opening bell.
All right, and that bell is a ringing. Taking a look at the NYSE where Project Hood is ringing the opening bell. And at the NASDAQ, you've got Pet Meds ringing the opening bell. Do we have some furry friends? Where is Billy at, Maddie? We need him. And images of Billy on a week like today. We could have just had a Billy cam to toss to going into and out of breaks. But anyway, taking a look at the NASDAQ and some of our furry friends there over at Pet Meds and, of course, our human friends ringing the bell. Taking a look at the major averages out of the gate here this morning, we are seeing some fractional declines across the U.S. major averages. Let's take a look at the Dow Jones Industrial Average down 0.2%. NASDAQ Composite flat just barely to the downside, and the S&P 500 that's down 0.1%. Since we were talking about the S&P 500, let's load up the 11 sectors on the S&P 500. We're relatively split right now, but pulling up the caboose, you've got real estate, financials, and technology kind of tussling for that final or caboose position within this train. But leading the train at the head of it is energy. That's right now higher by about 0.8%. Taking a look at the NASDAQ Composite, you're seeing some mixed activity here across the board. Looks like a little bit more red than green. Pulling up the caboose there, you've got Texas Instruments, TXN, that's down by about 8%, but leading the pack, you've got AMD and MicroStrategy, or just Strategy, excuse me. And then lastly, a look at the Dow Jones Industrial Average, the 30 components there. Looks like we have more laggards than leaders. Verizon leading, Apple bringing up the caboose. With that in mind, let's get on over to Yahoo Finance's Jared Blickery for a deeper dive into what's transpired, what has happened over the course of this week, Jared.
All right, I got 2 minutes to figure this whole thing out, so wish me luck. Here is the S&P 500. I'm going to show you the last 5 days. This has just been an incredible ride, and in fact, I'll put it into context a little bit more. Here is the year to date. fell off a cliff earlier in the week, in fact, going back to last week. And now this is really the sixth or seventh day that we felt this increased volatility. And I've prepared a graphic here to kind of illustrate what's going on. We have the prior 6 days returns and also the percentage of stocks in the S&P 500 that were advancing on the day. So for instance, yesterday, let's pick out this, or this is 2 days ago on 4.9, that huge update that we saw a rise of 9.5% in the S&P 500 with 93% of stocks going into the green. Then the very next day, we were down 3.5% and only 11% of stocks were in the green. So basically 90% decliners. And we've seen this 3 out of these 6 times. You can go back to 4.4. We had a 90% down day too that coincided with a 6% loss. All of this is what we see in a bear market, and I know that we haven't reached that magic 20% threshold in the S&P 500 just yet, but it certainly feels that way, and that's the way things are kind of acting right now. Got to get to the dollar real quickly. That is sliding the most in years since 2022. We are also at a multi-year low now. This is a 3-year chart. It is the lowest on that chart, and so we got to keep that in mind as we think about some of the risk moves that happen on the back of the weaker dollar here. And then here are the sector action. All 11 sectors in the red here, but I do want to get to a couple of the mega caps right now. I'm going to say this, and you might shrug your shoulders. NVIDIA and Microsoft are having their best week since September of 2024, best in scare quotes, but let's put the 5-day on and see how they are doing in terms of this entire week. And you can see Microsoft up 6%, Meta up 6%, NVIDIA up 15%, but it certainly doesn't feel like this has been the best week, just looking at the price there. I'm going to close with gold. I just want to tell you that gold is at a record high this week, and it has just been flying. And this is the best week for gold since 2020. So above, let's see if we can find this on the chart there, the exact price. There we go, 32.61, another record high for the yellow metal. Maddie?
All right, Jared, thanks so much for breaking down the week that was for us. Appreciate it. We're going to have all your markets action ahead, so stick around. You're watching Morning Brief.
As President Donald Trump's trade war heats up, the status of U.S. Treasuries as the world's safe haven is increasingly coming into question. Yields, especially on the longer-term debt, they have surged in recent days while the dollar has plunged. Here to break down some of the market action, we've got Yahoo Finance's Alexandra Canal. What have we been tracking here?
Yeah, guys, we were just talking about it. These moves in bonds have been so confusing. Bond prices and yields, they're inversely correlated. So you would think that a lot of people would be buying bonds to hedge against all of this uncertainty, to hedge against a lot of these recession risks. But instead, we're seeing bonds aggressively sell off. And if we take a look at the 10-year note, we are up nearly 10 basis points. We're trading at around 4.49%. This is actually higher compared to where we were trading on Wednesday, and it represents about a 62 basis point swing from the lows on Monday. So just incredible. There have been a few catalyst as to why floating around on Wall Street. One is the potential unwinding of the basis trade. There's about $1 trillion tied into that trade. That's a highly leveraged trade, usually used by hedge funds. It could be that. It could be the fact that investors just want to unload bonds, keep some liquidity, have some cash, especially during these uncertain times. Or it could be foreign buyers unloading their own bonds. About 30% of bonds are exposed to those foreign buyers. You think about Japan, that's one of the largest holders of our debt. China is also a big buyer, so perhaps there's some of that. And really, strategists and analysts that I've been speaking with have said it could be a combination of all three. I did have the chance to talk to Kathy Jones. She's a chief income strategist at Charles Schwab, and she told me that there's a potential for bonds to maybe hit 5%. She said that's the extreme case. She sees bonds coming back down to around 3.8% over the long term, perhaps over the next 6 months. But the more volatility that there is in this market, the more chaos that we're seeing from this tariff whipsaw from President Trump, the more you're going to see this reaction in the bond market.
And Allie, we got to head to our next guest, but important to note for our viewers that the bond market is really what moved the president this week. There was kind of a showdown with the bond nerds convincing the president to move the needle on his tariff policy. So a really important week to continue to watch the bond market. Allie, thank you so much. Appreciate it. It's time now for today's strategy session, a volatile week for investors calling into question long-held truths about investing. Should you buy the dip? Are bonds still safe? And could the dollar's dominance be at risk? Here to make sense of the market's U-turn, we've got Victoria Fernandez, Crossmark Global Investments Chief Market Strategist. Victoria, great to have you on this morning. Lots of big questions in the market right now, but I want to start on the moves that we are seeing in the bond market. Some similar activity to what we saw pushing the president to put that 90-day pause on tariffs excluding China. What do you make of the moves in the bond market we're seeing this morning, and do you think the bonds are still a safe haven trade?
Yeah, Madison, the bond vigilantes are certainly out this week and making their voices heard. And I think the administration responded to that. So when we look at bonds as a safe haven trade, yes, I think you can still count on bonds as a safe haven trade in terms of seeing things as a flight to quality. But I think what's pushing yields higher right now is a combination of what you guys were talking about a little bit earlier. You have gold down, equities down, and bond prices down. So that's telling us that there maybe is a little bit of concern from investors saying, maybe we move out of the US a little bit here. We reallocate to some other places, whether it's international or whether it's just other sectors maybe that they're looking at. Commodities are down and maybe they want to put a little bit to work in some areas that have pulled back. And obviously you have the unwind of a lot of different trades pushing yields higher as well. As you guys mentioned, a lot of the hedge funds and doing those basis trades and margin calls coming into play. So lots of different elements pushing yields higher. I'm not sure we see another reaction from the administration from the move that we see this week. I think they'll let it sit for a little bit and see if next week, as they maybe announce more negotiations happening, we see yields start to come back a little bit and settle maybe more around that trading range they'd been in for a while, around 430, 420.
Victoria, where else in the world are you looking right now as you talk about some of the global exposure that you're targeting?
Yeah, we've actually stayed more focused on U.S. domestic securities, and we stay U.S. on our fixed income as well. But you could start to look internationally in terms of looking at some companies that have a lot of exposure internationally. But you have to take into account what you think tariffs are going to do to supply chains, and you have to look and see what you think the dollar difference is going to do as well, looking at the currency exchange on that. We think actually we like financials here in the U.S., but banks have actually been doing pretty well internationally also. Japanese banks, European banks have been doing well. You had a big run up in Europe already a month or so ago when they added to the defense spending. So maybe you've missed a little bit of that and you want to wait for some consolidation. But I think you dip your toe sparingly and look at companies that have that broad base around them, good dividend plays and consistent dividends that can help buffer any kind of volatility.
What does that look like? Does it look like large cap value names?
We like large cap, obviously. We think when you look at large cap versus small cap, large caps have those benefits of having scale. Their earnings predictability is a little bit better. They're more consistent in what they can do. So in times of volatility, you would lend more towards the large cap. But it doesn't have to be all value. Value's had such a strong run, and we've actually been overweight value for probably the last 6-9 months. So we've actually been going in and trimming some of the value names and going into maybe some growth names that have pulled back significantly, but still have that strong balance sheet component, the strong earnings, the strong cash flow, huge factors that we look at for companies and start to build up some of those growth positions again.
You mentioned earnings. What is your trade ahead of? And as we're in the early innings, I mean, first at bats in earnings season now, as you're thinking about the amount of uncertainty we might hear about, as evidenced through Jamie Dimon talking about turbulence, as evidenced through Delta CEO Ed Bastian telling us about their own uncertainty in the consumer environment right now?
I think that's going to be the focus, Brad, of earnings. I mean, we always say the numbers they present, that's already in the past, right? It's all about the guidance that we have. And if we see companies start to pull guidance, like we did see from Delta, you had JPMorgan say they're not pulling it yet, but it is contingent upon what happens. That's going to give the market a reason to take a pause. We would expect earnings expectations to continue to come down. We started this year with expectations of year-over-year growth around 14%. That came down to 11. Now it's down to around 7. We would expect to see that continue. And I think that's going to be hard for the market when we came into the year really priced to perfection with high earnings expectations that will probably come down. And I think the guidance calls or the conference calls and what they say about guidance will really drive stock performance from here.
Victoria, thank you so much. Really appreciate your time this morning.
My pleasure.
Coming up, oil ticking lower this morning, but still set to end the week in the red. What that could mean for your prices at the pump. That's next.
Oil set for its second straight week of losses against the backdrop of an escalating U.S.-China trade war. For more on how trade policy will affect energy prices going forward, I'm going to bring in Patrick DeHaan, Gas Buddy, Head of Petroleum Analysis. Great to have you here with us. So just help us break down your own read-through on what tariffs and the trade war have ultimately meant for some of the ramifications within the oil and energy markets.
Well, we've all seen the stock markets reacting to tariffs, and I think where oil comes into play is oil is broadly tied to the economy, whether it's growth or whether it's not. I think demand is the major concern moving forward. That tariffs could certainly slow down the U.S. and, broadly speaking, the global economy, and that's sent oil down significantly. The other big part of this conversation, aside from tariffs, is probably one that some Americans may not have heard. OPEC has increased oil production, or it's restoring oil production that it had cut back in July of 2023 when oil prices were around this level, actually a little bit higher. And then for the month of May, OPEC accelerated the restoration of oil production cuts, or I should say the restoration of oil production. And so we're going to get more oil in the market at a time that tariffs are taking a big bite out of the potential for global growth. And so, as you mentioned, oil prices tanking to their lowest level since really the pandemic. And that, in turn, is going to make Americans' gas prices likely to go down here over the next couple of weeks.
And Patrick, usually when we're talking about lower gas prices for consumers, that sounds like good news. Is there a potential for this to tip into bad news where gas prices are so low it's indicative of a broader economic slowdown?
Yeah, this is a little bit different than COVID. Obviously, COVID and things like the Great Recession did cause a tremendous downturn in the price of oil and thus gasoline. I don't think the concern is yet as grave as it was during the recession or COVID, but still the price of oil and the aggressive sell-off, we were at $80 a barrel in mid-January, and now we're struggling to hold $60 a barrel today. That is telling us that there's a lot of distress or concern about where the economy is heading. So while a lot of Americans love to cheerlead low gas prices, and potentially no one more than I do like to see low gas prices, it does come with alarm bells that are going off about the economy. So it's certainly something to keep in mind.
You know, as we think about what President Trump has talked about in wanting oil companies and some of the energy companies who are drilling to drill, baby, drill, it also comes in an earnings season where we're going to hear from some of these CEOs who say, okay, well, that's not exactly sustainable, or maybe they might talk about what it is, what sustainability there is or not for their continued efforts in drilling to bring down prices. What are you anticipating to hear?
Yeah, absolutely. It's going to be a relatively somber earnings season where oil companies, at least upstream oil companies, not diversified oil companies, are probably going to be very worried about the underlying cost of a barrel of crude oil. For areas of the U.S., the break even could be between $50 to $60 a barrel. And now with us testing some of that, some drilling in some areas of the country are probably going to be less affordable. Now, the Permian, you probably can still pull oil out of the ground profitably at $60 a barrel. But there are certainly other areas, the Bakken, where oil bringing it to the surface is more expensive. So again, oil executives are probably going to sound off a little bit about the fall in the price of oil. And that is something that's probably going to fly in the face of that drill, baby, drill mantra. And that's probably not going to go away, especially in light of OPEC raising oil production. I think the biggest question here is what is going on with OPEC's strategy? How long are they going to stick to the strategy of restoring oil production if the global economy does slow down?
How does the stagflationary environment impact the price of oil? I know, for example, in the latest CPI print, gas prices, while down from a year ago, were up for the month of March. Talk me through how that stagflation growth coming into question, but inflation continuing to reign could impact things going forward.
Well, I think energy is one of the biggest spots that we've seen disinflation. That's really pulling a lot down in the CPI. Now, of course, it's more the active area. Food and energy prices tend to be a little bit more significant movers. But to your point, yeah, we have oil prices that have now completely eroded compared to last year. Gasoline prices 45 cents lower. Americans saving over $100 million now. every day in terms of what they're spending at the pump. Overall, though, as you mentioned, if we do see an economic slowdown, gas prices being disinflationary is still likely to be the secondary role here behind the economy. So, all in all, it's good news for Americans that gas prices are coming down, but against the gravity of what could be economic weakness, it's not the greatest outcome.
Yeah, Patrick, we're certainly going to continue to track this. We know you will as well. Good to see you this morning.
You as well. Thanks.
We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief. We're taking a closer look at some trending tickers this morning: Tesla, Apple, and JPMorgan Chase. First up, Tesla has stopped taking orders in China for two models that are imported from the U.S. That includes the Model S sedan and the Model X sport utility vehicle. You can see on their website the Models Y and 3 have a button that says Order Now, while the Models S and X say View the current car. This comes amid an escalating trade war between the countries, with the U.S. raising its levy on China to 145% and China retaliating with 125% tariffs on American goods.
Plus, Apple feeling the heat of President Trump's trade war. Although many reciprocal tariffs on countries got a 90-day pause, China certainly not one of them, with the U.S. tariff rate on Chinese goods at 145%. Wedbush's Dan Ives saying no U.S. tech company is more negatively impacted by tariffs than Apple, with 90% of iPhones produced and assembled in China. CFRA sees 50% odds of Apple receiving a tariff exemption. Apple has vowed to invest $500 billion domestically over the next 4 years. And the White House says Trump believes iPhones could be made in the U.S. Analysts, however, have their doubts on that.
Finally, JPMorgan Chase CEO Jamie Dimon is warning Americans that the economy faces, quote, considerable turbulence. Jamie Dimon making the comments in JPMorgan's first quarter earnings report, where the firm saw a rise in profits. Earnings rose 9% from a year ago, but the bank also set aside 75% more provisions to cover future loan losses, a sign that it expects borrowers to run into more problems ahead. Dimon mentioned, quote, potential negatives of tariffs and trade wars, sticky inflation, high fiscal deficits, and volatility.
And you can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Let's go out with a quick check of the markets here. Your S&P 500 and your tech-heavy NASDAQ, all of your major averages moving to the upside. Your tech-heavy NASDAQ taking the majority of those gains, up about 0.9%. But I gotta get a check on our bond market here, because this has been driving the trade this week, and you've got yields continuing to move to the upside. The 10-year yield hitting its highest level since February, and it's actually higher than it was when Trump conceded to the bond market and put that 90-day pause on tariffs. What does that mean for the market going forward? I'm going to cover that and much more next on Catalyst. Stick around.